I want to talk about tax basics because it's a concept that is not well appreciated in the investment world. I think most people like to think of investing as achieving the highest return possible, the thrill of investing in the right stock or the right mutual fund, and taxes are an afterthought. But I think it's very important to realize that the only thing that really matters at the end of the day is the after tax return. Gross returns are of little value to the investor if what's coming in his or her pocket is much less than that. So let me approach this from the U.S. tax system to illustrate this concept. You have two types of income categories in the U.S. system. You have ordinary income and capital gains income. Ordinary income is taxed at the highest marginal tax rate. Currently, if you were in the top of the top income earners, for every dollar that you earn and that's classified in ordinary income, you would pay about 43 cents to someone else, to the U.S. government, right? And this is not including the state tax, which if you're in California, you'd probably pay another 10 cents or so to the California government. So a big deal. And the type of ordinary income examples that I want to show is salary, which is W-2 income, interest income that's generated through bonds or savings account, checking account, so forth. Any investments that you hold for under 12 months are classified as short-term capital gains, which typically are taxed at ordinary income rates. Capital gains, by contrast, are taxed lower. Currently, the maximum federal rate sits around 23.8%. Again, if you include the unearned income Medicare contribution tax that we currently have, and also state tax would probably be around 10-12% if you're California and so forth. Now, this is taxed on long-term investments such as stocks, bonds, real estates, business sales. And I think the takeaway here is if you can have some control over it, try to have as much in capital gains and as possible and as least in ordinary income. The reason Warren Buffett is so successful and is taxed at such a low rate compared to the rest of us is that most of his income is classified as capital gains as opposed to ordinary income tax rate. So I think every year he publishes what his tax rate is, and it's usually much less than the 50% or so that most of us pay for income. So what's the perspective, right? I have two bars here. One is on the left, it shows historical U.S. stock market returns on an annual basis. You have 8%, and then you have 55% for the highest combined marginal tax rate of someone living in California. So the bottom line is that most people will spend their energy and resources here trying to beat this, trying to do better than the stock market, and in a very competitive and efficient marketplace, whereas they'll spend less time on trying to figure out how to achieve a savings from a tax perspective, which could yield a greater impact. And in my experience, talking to folks and myself as well, the inefficiencies are abundant in this tax area. I mean, there are a lot of things that go undone, or they're not done correctly because most people don't spend a lot of time around here, and most tax accountants are essentially compliance officers, are not strategists. So I think my recommendation to my clients is to really focus here instead of here. Both are important, but this could be in some cases much more important. I want to put this in perspective from a retirement accounts. It's you can think of retirement as saving for your golden age, but you can also think about it as a tax strategy tool. And I just want to show a basic math example. If you had a taxable account at Charles Schwab, a regular brokerage account, you could invest $10,000, and out of your pocket, that means $10,000. A very basic concept. It's if you're doing a taxable account, you're investing with after-tax dollars. So the tax implications, and depending on what you put your money in, could be capital gains or ordinary income, depending on which vehicles you choose. If you had a tax-deferred account like a 401k, investing $10,000 in a 401k really isn't $10,000 out of pocket. It's $4,500 out of pocket if you assume you're in the 55% rate. And this concept applies if you're in the 30% rate. It would be $7,000 in that case. But the bottom line is that you can put money to work, the same amount of money to work, with less out of pocket, which is important. That's the only thing that's important in my opinion, than you would in a taxable account. In a taxable account, to put $10,000 to work, you really have to come up with $10,000. If you want to put $10,000 to work in an investment account, such as a 401k, then you only need to come up with $4,500 out of pocket. And what happens, right? I mean, at some point in the 401k, especially, you're going to have to pay the piper. You're going to have to pay income tax on that amount. So it's not really like you're avoiding the tax, but you're deferring it. And there is substantial value, especially if you're in an age where you have a long time towards retirement, in that deferral process. So I do recommend to my clients that before investing in anything else, they max out their 401ks and tax-deferred accounts, SEP IRAs, and so forth, because that is a more effective tax strategy tool than investing in a taxable account with after-tax dollars.